Welcome back to the Wall Street Podcast. Today, our deep dive analyzes JPMorgan's research report, Mart H, which came out July 27, 2025. This report pulls together insights from a fireside chat they had with a major toy OEM supplier, and it also tackles that recent, maybe worrying 5% dip in search interest for Mart's Labubu IP.
Right, but despite that dip, JPMorgan is actually reaffirming their overweight rating. They're sticking with a June 2026 price target of HK $340 for Mart. That's ticker 9992.HK.
Which is quite a bit higher than the closing price on July 25th, HK $245.20.
Exactly. So the report breaks things down, starting with supply chain dynamics. What are they seeing there?
Well, it seems OEM supply is pretty tight right now. Apparently, more IP brands are shifting their sourcing out of China.
Yeah, benefiting places like Vietnam, Indonesia, India, even Mexico. Production lead times are running about 3 to 4 months on average.
And Mart specifically, they've confirmed July production will actually be double what it was in June. So they're ramping up.
That's significant. And there's an interesting point about bargaining power, too. The thinking is that strong super IPs, the really big names, will gain leverage.
Meaning they can push back on bearing tariff costs.
Precisely, which implies potentially better margins for Mart down the road. In fact, Mart's chairman is projecting Labubu's monthly sales could hit over 10 million units after September 2025.
Wow, 10 million. That's ambitious. Which brings us to the IP lifecycle question, especially with that Labubu search interest dip you mentioned.
Right. The 5% global decline, it definitely got the market's attention. We know average IPs might last, 6 to 24 months?
Yeah, but the super IPs like Mickey Mouse or Hello Kitty can go for decades. Mickey's 97 years old, Hello Kitty 51.
So JPMorgan's argument about the Labubu dip is crucial here. They're saying for a new hit IP, search interest is more about the pace of new customer acquisition.
Not necessarily a direct measure of sequential sales, particularly once people actually know the brand exists.
Exactly. And Labubu's search index, even after the dip, is still incredibly high. It's 13 times higher than Kaz and 2.5 times Hello Kitty. That provides some context.
That's a huge difference. Is there any historical precedent they point to?
Yes. They looked at Hello Kitty. Her sales growth stayed positive, actually up 20%, even after her search index fell significantly from its peak. Their regression analysis suggests IP sales might only really start to decline if search interest drops below, say, 21% of its peak value.
Okay, so that 21% is kind of the threshold to watch. Labubu isn't near that yet.
Not even close, based on these numbers. It suggests the brand awareness is established, and the dip might be more noise than signal right now.
Got it. So looking ahead, what does the report flag as key growth drivers or catalysts?
They list about 6. First, the upcoming first half 2025 earnings print expected mid-August. That's always key.
Naturally.
Then opening 2 new P.O.P.O. jewelry shops featuring Labubu and Crybaby. Also, the Labubu and Friends animation series debuting this summer. 20 short episodes.
Animation. And wasn't there talk of Hollywood interest?
Reportedly, yes. Potential movie collaboration down the line.
Interesting. What else?
The Labubu X Unico t-shirt launch in August. That could be big for visibility. Then the Labubu 4.0 trailer and launch before the holidays. And finally, the potential for new kinds of toys, interactive or maybe even AI-driven ones.
Beyond products, what about their user base?
Huge growth there, especially in China. The member base went from 2.2 million in 2019 to 46.1 million last year.
A 20-fold increase. That's massive.
Yeah, hitting about 16% penetration among 20 to 45-year-olds in tier 1 to 3 cities. And they forecast 70 million members by 2027.
And global expansion is obviously part of the plan, too.
Absolute critical. Overseas sales were up 234% year over year in 2025. Projections show international contributing maybe 67% of total sales by 2027. So a huge shift.
Okay, so lots of positive catalysts and growth potential. But the share price, it's down 7% since the mid-July profit alert, while the Hang Seng Index actually went up 3% in the same period. How does JPMorgan explain that?
Well, 2 main things according to the report. First, the profit alert, why positive, just met the low end of what the buy side was expecting. So maybe not enough positive surprise.
Met expectations, but didn't beat them significantly.
Right. And second, the market's reaction, perhaps an overreaction to that Labubu search interest decline we discussed?
So market sentiment playing a big role there.
Yes.
Are there other risks highlighted?
Oh, definitely. Standard stuff, mostly, but important. Delays in new IP launches, not renewing licenses for existing IPs, challenges executing the overseas expansion strategy smoothly, increased competition, always a factor.
And potential U.S. tariff hikes are still on the radar, too.
Yes, that remains a background risk for many companies.
So it really paints a picture of a company with strong IP and growth plans, but facing execution risks and market sensitivity.
It does. And perhaps a closing thought for you to consider. Think about how that careful strategic management of intellectual property, combined with being really agile in adapting to these global supply chain shifts and market perceptions, how all that together will really define who wins in this rapidly changing consumer collectible space. It's not just about having a hot character.